we're almost 5 minutes past, so I'm going to kick it off. I expect people will keep trickling in here. So firstly, I just wanted to share my gratitude again. As I mentioned, we have close to 100 people that have registered for this webinar, which is the first that we've hosted here at Tallbridge Capital. So really excited personally to get into this conversation. My name is Josh Alter, for those of you that don't know, and I'm the CEO of Tallbridge Capital and the co-founder of the Tallbridge Group of Companies. It is an extremely exciting and interesting time out there right now. Certainly a lot of noise and uncertainty, but with that, we believe tremendous opportunity. And we look forward to really unpacking some of this over the next 45 minutes. The objective of this webinar is really to dig into some of the dynamics at play right now and the impacts this is having specifically on the real estate investment space in the United States. We have Matthew Fiallo here, who is our Chief Investment Officer, and I'll introduce him a little more formally in just a minute, who's going to help provide some perspectives, our perspectives on how best to manage this current market landscape, and more importantly, capitalize. Because again, we're very bullish on what's happening in the U.S. and want to ensure we're providing a lot of value so people can be well positioned to take advantage of that. One thing I'd ask is, as questions come up, it's a relatively brief presentation, but I suspect there will be questions. Please use the Q&A feature within the Zoom webinar. And towards the end of the conversation, there will be an opportunity to dive into some of the questions, time permitting. If we're not able to get to them in the sort of live webinar, I'll be sure to make sure we're following up with everybody afterwards. So I'd like to kind of kick it off with a question to the group here. And the question is, how prepared are you to capitalize on the next 12-month real estate investment cycle? So if you could take a quick second, throw up your answer. So are you ready to rock right now? You got a solid plan, you're taking action, you're sort of in a bit of a holding period here, feel that you'll be in a good position to get going in 6 to 12 months, or like some, frankly, sitting on the sidelines and waiting. So I see the answers kind of coming in here, and then I'll share the results here in just a minute. And I'm really interested to see how the tone or your opinion of this question potentially evolves as we kind of go through the conversation today. All right, so we got 50 or 60 responses. So I'm going to go ahead and end this poll, share the results so you guys can see. So it's interesting. Matt, are you seeing the results on your end? Yeah, okay, awesome. So close to 50% ready to go. Okay, that's awesome. I like that. Not surprised to see the other 50% sort of kind of waiting a little bit to see how things land. Again, there is a lot going on right now in the market, and I know that some folks are really still sort of in a bit of a holding pattern. So let's kind of get into this conversation, and again, will be interesting to see how the tone changes throughout the presentation. So we do have a lot of new names that have registered, which is great. Some familiars as well that have joined us today. So I wanted to just kick off with a very brief introduction so you guys know a little bit more about who we are. Tallbridge Capital, we are a Canadian-based firm based up in North Vancouver that focuses specifically on US-based multifamily investment opportunities. We syndicate private capital for our projects, and our core strategy is focused on value-add income-producing assets in high-growth markets, specifically in the southern United States. Tallbridge Capital is part of the Tallbridge Group of Companies. Our sister company, Tallbridge Real Estate, was initially founded in 2015 to develop a platform which we now manage that acquires off-market investment opportunities throughout the United States. So we have always been focused entirely in the US. Got our start originally in Austin, Texas, and have scaled into close to 50 different markets over the last 7-8 years. I'd say this illustration really doesn't do the journey justice. It probably deserves a few more twists and turns and ups and downs. But we, are very proud of what we've built over the years. We've executed north of 600 transactions, a blend of single family portfolios, multifamily assets. And at our peak, we grew our team to close to 60 people. So certainly have an appreciation for what's required to grow, but more importantly, sustain a great business. We have an awesome culture. Very grateful for the team, both on the real estate side and the Tallbridge Capital side of things. Here's our core executive team leading the charge at Tallbridge Capital specifically, as well as our unbelievable board of directors. The core of our team here are based in Canada. Matthew, I'll touch on his background in just a minute, is actually based in the United States. This group offers a breadth of multidisciplinary expertise, responsible for executing over $1 billion of transactional value. So just a ton of experience within this group in all facets of real estate, asset classes, and geographies. Most importantly, I guess the point that I want to highlight, and for those of you that have had an opportunity to meet members of our team, we really pride ourselves on a strong sense of principles and values. It's something that we talk about a lot within our organization. And frankly, we look at ourselves as just a real group of individuals that really focuses on building real connections. So for those of you that are new to this call, that haven't had a chance to connect with us, personally hope that I have an opportunity to have a follow-up and meet and or speak with all of you at some point in the near future. And I'm sure you will come to realize end of the day, we're a good group of people that are committed to doing good things and build long-lasting, high-value relationships. So let's briefly introduce Matthew Fiallo, our Chief Investment Officer, man of the hour, one of the smartest guys I've had the pleasure of getting to know this year. Just brings a tremendous amount of real estate experience over the last couple of decades. I will say sometimes in my conversations with Matt, I kind of find he sort of talks a different language. He operates at a really high level. So I'm going to do my best here to translate as we really get into the core of the presentation. And I know when Matt hates when we refer to him as this in our office, but we do often kind of refer to him as our oracle. Just pretty remarkable how much he knows about so much. Throughout his career, has worked with some of the largest institutional groups in the United States, has really touched almost every major market and asset class, has been accountable for managing and deploying a lot of capital, both on the debt and equity side of things. So you guys are in for a treat, and we're really going to do our best to kind of get into this. So Matt, I guess you could probably unmic it now. We're going to get into it. Are you good to kind of dive into the meat of the presentation? Yeah,
absolutely.
All right. So we've coined this webinar the perfect storm, and we feel this is a great analogy that addresses a lot of the noise, chaos, and opportunity that is prevalent in the current market. And we're going to do our best to unpack as much as we can here in the next 35-40 minutes. So where I'd like to start, Matt, is with a question to you. Looking at the diagram here and everything that we're seeing out there, can you highlight, in your opinion, what you believe to be some of the key variables that are creating this dislocation, this noise in the current market?
I mean, it purely lands on the interest rate environment, right? And that's what has the steep hockey stick effect of raising rates here in the United States and the globe to follow, for the most part, has been pretty tough on the markets, and particularly for the multifamily side. Let's just stick with multifamily since we're there. It's been a really tough climb coming out of the COVID period. So as folks were banking on high growth, high margins, those have completely been squeezed, and now they're getting it felt on the shorter end of the curve where folks are coming up on maturities or renewals or extensions that they need to take, but they can't make their financial covenants. So there's just a lot of basic mistakes, to be honest. A lot of buying effectively neutral yields compared to the treasury rates. And when the rates have just moved up, long-term rates have moved up, everyone's moved up with them. Excuse me. And now everyone is in a pickle. So it is, I think the perfect storm is probably the great way to look at it, because there's tremendous opportunity, especially in the area of the space that we're playing in and looking at within the lower middle markets.
Well, that's great. So what about liquidity? You know, we're hearing a lot of pressure and distress right now with groups that are coming up on refinance, looking at creative ways to source debt for the projects. What are your thoughts in terms of the pressure that's applying and opportunities that's going to present us?
Yeah, there's a lot of money sidelined. I mean, we can see from even the poll here, right? There's a lot of money that's being cautious, but you're starting to see larger groups. You're starting to see the institutions start to dip back in. And as the institutions dip back in, that typically will allow others in the retail market to have confidence, because apparently we all think that the institutions are the smartest folks in the room, right? And that's typically how it's sort of a lemming effect, and everyone will kind of crowd in. I think that the opportunity does lie in those where we're at, specifically where there's less sophistication and less capital. Folks aren't wanting to put good money after bad, so there's going to be a decision period over the next 12 months, really over the next 24 months for some cases, and maybe some folks will get bailed out. But for the most part, there's going to be a tremendous opportunity to come in here in the lower middle markets and really not scrape the bottom, but really get a good handful of fantastic transactions, I believe.
Awesome. I know another hot topic is inflation. You kind of hear a lot about that and speculation in terms of kind of what's going to happen in the next 6 to 12 months. So, you know, I think our sentiment is, you know, we're coming to grasp with the risk of inflation, but it's still very much a hot topic. So what's your opinion on, you know, where things are headed and trending?
Yeah, I mean, it really depends. The P&L or operating statement for properties that covers a large swath of sectors, right? So you have wages. Wages have been growing, particularly year over year, and the biggest one has really been insurance, and insurance has been a really tough one for the insurance companies. So you're seeing in South Florida or Florida, where it's been very, very difficult. You're having doubling in costs, rates, and Texas also. So those have been the biggest concerns. And then taxes, I think, are going to be something to have to reckon with if these states do have trouble. You're seeing, for example, in parts of Texas, you've seen some really, really large increases in taxes, and it's not sustainable. It's the biggest portion of the operating statement, and that's the one place that we're really concentrated on to make sure that we get it right and we understand where that underwrites.
Yeah, it makes sense. So I guess from our perspective, as we're looking at opportunities and other individuals are looking at opportunities, safe assumption we'll continue to see pressure, appreciation on some of those key line items, tax, insurance, as it relates to more of the traditional multifamily cost drivers, probably starting to see things stabilize a bit, you know, costs of materials and construction, things like that.
Yeah.
Would you say that's sort of a reasonable?
I think, yeah, the cost side on like materials is pretty stable now. It's more on the contract services where you're seeing against wages. It's all that type of stuff that kind of flows in. But I think it's still going to be a procurement market, especially on these value add deals. where you're going to have to really pay attention and be ahead of the curve, because provided we think that inflation will be, the Fed here in the US will be able to get everything under control. There's still the build out of the procurement side, which is in various sectors, right? You're already seeing it be fulfilled. You're starting to see groups and warehouses have plenty of capacity now, and actually have too much. So we're probably going to be going into maybe what we might consider like a Goldilocks period for procurement. So I'm hopeful that that won't be an issue.
Got it. I know we've looked at probably certainly north of 100 projects here in the last 45 days or so, and you're one to really preach, this function of underwriting and analyzing deals is less a science, it's more an art, right? There's so much of this subjective sort of context and hindsight that you need to be able to really anticipate and predict. So as much as we'd love to kind of have a black and white application, every single deal we look at, it really requires frankly experience, right, to be able to forecast and make sure that you're hedging when we're looking at all these deals. So that's great. Okay, well let's transition. I want to talk now a little more specifically about the United States. This is a busy slide. I appreciate that very much, but I do believe it highlights a lot of the key drivers right now and impacting the United States specifically. The illustration shows what it's showing us is the movement of people, capital, and jobs. I heard a really interesting quote the other day that this is the greatest reindustrialization period for America since World War II. Pretty bold statement. So I'd like for you, Matt, to kind of give us your thoughts in terms of that quote and some of these drivers that we're seeing in the United States that would imply, that this opportunity is really, really ahead of us.
Yeah, I mean, look, the policies that are put in place right now are mainly driving a lot of this infrastructure development right now that's going to take place. There's a lot of onshoring fabrication. There's a lot of onshoring even actually in the Mexican territory, or in Mexico, should I say. And that onshoring is going to produce a lot more near-end goods, right? And so you're going to have the highly skilled individuals to basically work in these factories, right? And that said, we're seeing a lot of movement into the Carolinas, into the both South and North, Texas, obviously, and the Phoenix area, right? And then you have Intel even going into the Ohio region. But there's so much going on right now in the various markets. Even the coasts have a lot going on. I would not second guess what can come out of the coastal regions, especially in the Northeast and the entire West Coast, or at least for California and Seattle. But this is going to be a very interesting time period. I think this is going to be a decade. No, go ahead. Go ahead.
Well, I was just going to comment on, we're coming out of a few years of COVID as well, right? So this relocation that's taken place, when individuals have the opportunity to relocate south and pay a fraction of their rent, achieve a better sort of standard of living, continue to work great jobs. It's interesting to try to forecast, what this ongoing trend is going to look like in terms of, where are people going to work, right? Is there going to be this movement back to the office? Actually was seeing on the news this morning, that New York finally sort of surpassed the 50% mark or something like that in terms of people coming back to the office. So what is your thought in terms of sort of this new norm, I guess, right? And in terms of the flexibility that people are now used to, do you think that trend is going to continue?
I generally think so. I mean, it's anyone's guess, but I do generally think that there's been a shift in the mindset of most workers. I do think that there's going to be a skills generational gap
Hmm.
that's actually occurring now. And that probably will have to that will get smoothed out some way somehow with corporations actually making folks actually come back into the office. A lot of groups I'm seeing are 3 days a week. It's typically Tuesday, Wednesday, Thursday.
Hmm.
So it's the various markets, really the coastal markets again, that the high tech centers and the LAs, the San Francisco's, and now Seattle obviously has a huge component with Amazon, and with Amazon's return to work program now, like they're seeing a lot more activity down there. But I do think that there's utility within the office sector as far as like culture, cross skills, etc.
Yeah.
I grew up. I came up through the ranks basically. Right next to, I'm literally right next to the person that I was under tutelage of. So
Hmm.
for the most part, that was my entire career, or vice
Yeah.
versa, as I got older. But I don't think office goes away.
Yeah. Yeah. I relate to that. I spent my corporate career in an office environment, that this concept of remote work wasn't really even a thing, right? Unless you're an independent consultant. And now I find us, we have this beautiful 7,000 square foot office, and coming out of COVID, we have a ton of flexibility. We have a distributed global team, and it presents a different nuance of challenges for sure in terms of, fostering high performance, culture, those variables. But I do believe this is the reality. This is the expectation of the workforce, especially the new workforce coming to the market. And so I think that bodes well for locations, geographies that have that appeal, right? That attractive, desirable place to live, right, where people can achieve that balance. So
Yeah,
yeah.
just to top it off, I don't believe the urban centers are anywhere near going to die. You cannot duplicate a New York, you cannot duplicate a San Francisco, LA. It's very hard to duplicate Miami, right? Like
Yeah.
these places aren't going to go away.
Yeah, that's a good point. Good point. All right, so going to kind of move us along here. So we've unpacked some of the drivers, variables, trends that we're seeing out there. So let's talk about what we can do to prepare and to my earlier point, really capitalize on the next 12 to 24 months. So of course, nobody has a crystal ball. We cannot forecast. I guess we can forecast, but nobody can say with certainty what's going to happen. But we do have the benefit of hindsight, and I think reflecting back on the past year, and frankly, we're seeing it in the deals, right? As the more projects we look at, sort of the writing is on the wall. And one thing that appears to be apparent is that there has really been a disregard for the fundamentals. I think over the last 5 to 10 years, with sort of this run in the markets, there's been a relatively easy opportunity for people to do well, right? And now you're starting to see the distress really kind of hit paper. It's in the underwriting of deals that we're looking at. So, acknowledging all of that, Matt, what are some things that you can do to hedge risk and be best positioned to take advantage of this wave of opportunity that we see coming here in the next year or so?
I mean, it's a very hard question. I think the best way to hedge risk is really to get a handle on the largest component, which is your debt, and make sure that you're either not over leveraged and paying too high a cost of capital for that leverage. So the way that I'm looking at transactions today is trying to be on the more moderate edge of the curve, meaning like 5 years, not really trying to go out to 7, but looking at more of 5-year fixed. and seeing if we can buy these rates down, seeing if what we can do, seeing how we can be flexible with the prepay if rates do go back into the capital markets favor, right? That way there's at least an early exit if there's the possibility to actually execute on, you know, cheaper cost of capital as things kind of like stabilize again. But I don't think it's going to be anywhere in the short term, meaning like the 2 to 3 year period. So you really have to be buttoned up. The only thing we do know is like maybe 12 months ahead of us, if we even know that, right? Like that's probably even that's not even probably, it's a guess too, but at least what we're doing is we're building the margin early on. So the money's always made on the buy, and you're going to know whether you're going to do well or not the day you bought it.
Yeah. Yeah. I would say, you know, this is kind of the other side of the coin of everything that's going on right now is that, you know, for those groups that have the ability to be patient, to be selective, I think that that's certainly one of the byproducts of the distress here is it does position you to have more choice, but the discipline that's required to make sure you're making the right choices is the challenge, right? So, yeah, like, can you touch on that just a little bit? Like, what are some, maybe flip that, what are some of the kind of market specific fundamentals that you would recommend be a high priority right now? And I know you've talked barrier to entry, various economic, political, regulation. Like, what are some things that really kind of jump to mind that should be top of mind when we're making decisions?
I mean, look, all real estate's local, and I think it really has to be block to block in certain markets. So you really need to know where you're at within the corridors, where you're at in comparison, or as far as distance wise to the major job centers, right? And where we're looking at mainly is workforce housing. So you need to understand where that workforce housing actually is working, right? So it's really paying attention to the tenant base and the cohort that you're going after. And in our case, again, it's really staying near the job clusters and lifestyle, right? Like if we can balance those two out, where folks don't have to live, you know, an hour and a half out from, you know, the job center, and they can live closer in and actually have a good community. So like there's so many boxes that need to be checked. All of them aren't going to be checked, but we're definitely paying attention to kind of a holistic look at you know, what the product offers.
Yeah, I mean, it's interesting. This is somewhat timely. I'm thinking to our team meeting yesterday afternoon where, you know, we're seeing this massive inflow of opportunities, you know, off market specifically, that come through our funnels, and lots of different deals that we can be looking at. And ironically, we find ourselves almost, it's like this fire hose of too much, right? And so what, you know, we did yesterday as a group is we took a step back and we said, okay, you know, we have the ability to be even more targeted than we would have been, you know, 2 months ago, and really refining that buy box, the criteria, those preliminary filters to basically help us prioritize the deals that we want to be focused on. So I think this is something this is constant, iterative, especially over the next 6 to 12 months. It really does afford everyone an opportunity to be more critical and patient. And I know that's something that I personally, you know, I kind of go, you know, let's buy. And Matt was very mindful of saying, okay, yes, we're all aggressive here. We want to get into some great deals, but we have the ability to be patient and really make sure we're landing on the right opportunities. So yeah, it's interesting. I know we were preparing this presentation, and here we are, you know, 24 hours later. We've just gone through kind of like a real example of doing a bit of a reset here to get even more targeted. So practice patience. Yeah.
Practice patience and you will find the gem.
Professionally and personally. Yeah. All aspects of life. Awesome. Okay. So that's great. So what I want to do now, because I do have a few questions that have come up, you know, we've kind of touched on the key aspects of what we wanted to cover today, and really kind of hoping to kind of wrap this up in 40-45 minutes. So a few questions that I'll get into, and I'm just kind of seeing these pop up. So I will kind of throw one out here for you, Matt. So the question is, will demand and rents continue to rise in the hot markets? When will things top out? What are your thoughts in terms of that?
I mean, it's really, I mean, it's supply and demand, right? So I do think that things are starting to, it's not even I think the data is already telling us that we're hitting you know, the ceiling in most markets, in a lot of markets. Specifically, if we look at Texas, the southeast part of the Sun Belt, you're seeing trade outs that are actually negative. You're seeing trade outs that are negative in the Arizona market that has been extremely hot, probably one of the hottest. That probably was the hottest market during this whole run up, post-pandemic run up. That was quite, I mean, absurd in my opinion. But that said, I think that's going to lead to a lot of opportunity, because you're having rents go down, folks still need to execute business plans, and they're getting zero return. They're going to effectively capitulate at some point.
Yeah.
I think that it's definitely going to be, we're in most markets, again, we're seeing that things are plateaued, and then in other areas that didn't participate, you're starting to see actually, you know, green shoots.
Yeah. Well, and I'm sort of kind of partially smiling because I live in North Vancouver, and for those of you that know this market, it's a very expensive place to live, right? And so often I kind of ask myself the question, you know, why, you know, why do we continue to see pressure on rents and affordability, but somehow people still manage to find a way to live here, right? And I do think, especially on the rental side, you know, that's a space that continues to grow, and I do think a lot of that is attributed to just the difficulty and affordability to buy, right? And so when we're looking at market selection and opportunities, and while I, you know, certainly agree that we're seeing a plateau, the demand, the consumer demand that's driving growth and projects in these key markets where people want to live, right? It kind of comes back to the basics of, you know, where do people want to live, right? And that's going to continue to be, I think, a big driver for sure.
Absolutely.
Okay, got another question here, and if there's any other questions, I see no one's popped up, so we'll get that to that. Please, you know, this time, please throw those in the Q&A. So here's another one, Matt, for you. There has been massive investment in the multifamily space in recent years, especially by some of the biggest firms. Is it too late to be getting in? If not, where do you see continued opportunities?
Repeat that question. Sorry, I had
no worries,
on my screen.
Yeah, no problem. There has been massive investment in the multifamily space in recent years, specifically by some of the biggest firms. Is it too late to be getting in? If not, where do you see continued opportunities?
Yeah, there's been tremendous flow into the multifamily space and all housing strategies. There's such a supply constraint on housing. There's just a number that came out the other day on single family starts for May, actually, were up. That wasn't really expected. So I think that folks are gearing back up for that push. The differential between rent and buying right now is so far apart, that a lot of the areas are going to be unattainable, as you had mentioned earlier, right? Yeah. And people have to follow, either jobs have to follow people, or people have to follow jobs. But in most cases, people follow jobs, right? Historically. So I think the opportunity really is going to be the contrarian play and stay away from where the institutions really are, or play around the edges around the institutions. The institutional money plays completely at a different set of rules and yield parameters. So I think there is going to be a lot of opportunity in the space, and particularly it's going to be more so in the workforce housing part of it, not in the Class A. I think opportunistically, if you're able to find Class A assets that are under distress, there's going to be plenty of liquidity for it. It's a brand new asset, and it's probably in an urban market that, you know, has a lot of strong fortress-like qualities. But the workforce housing side, the affordability side, I think has been very much underrepresented. If you look, no one's building that, right? They're building Class A.
Yeah.
So that's really where it's going to lie, where the opportunity is going to lie.
Makes sense. That's great. Another question here. Where do you see cap rates and returns heading in the next 6 to 12 months? It's time to pull out your crystal ball.
Yeah. I cap rates, I think, are going to, cap rates have to gap out, right? Like they've already gapped out in most markets. I think that a lot of sellers are still trying to hold on to cap rates of 12 months ago, but the new reality of what the financing instruments do to your underwritten or your potential total returns, your IRRs, they have to gap out. But I think everyone's going to have to come to grips with the new reality that returns are actually, as a result, are going to expected returns are going to come in. So historically, you're high teens on, like, for example, value add, and I think that you're probably going to be coming in. We've seen early on when we were over the last, call it 9 months, as we've been putting together these strategies, that on the construction side, construction short-term rates were just so are continue to be so out of whack, like along with spreads, that the returns are value add looking returns, and that's very difficult for anyone to swallow at this time, right? And so value add returns have come down like 200 to 300 easily 200 300 basis points, if not 400 for most part. So you're looking at I think there's a new reality for the next 24 months, and I think if anything, which is fine, but there's probably the ability to outperform in the long run if you're looking at, again, assets that are more cash flow based. I think that's the other thing, is that fundamentals need to come back into play here, and more of your return needs to come from cash flow. No, that's spot on. I'm going to kind of provide my attempt at that question too, because I think, you know, one of the interesting things that and advantages of what's happened is, you know, these returns that you speak of, and yes, there's sort of an adjustment in expectations, but I would argue that the returns are more of a risk adjusted sort of forecast, meaning there's a higher probability, less speculation tied to those returns than perhaps there were, you know, in the last sort of 3 to 5 years. So while, you know, some groups were achieving higher IRRs, you know, a lot of that was speculative, and frankly, wasn't even in their control. It was sort of external market factors that are frankly really difficult to forecast. And so, you know, the conviction that we have as we're underwriting projects, taking a very conservative forecast approach, I think is going to give us a higher degree of certainty of achieving those targets. So definitely some, you know, I think some shifts within expectations, but yeah, the predictability I believe within the underwriting is stronger. So that certainly helps me sleep at night. Couple questions here. Let's take a look here. So question from Ray here. So I know Ray's based here in North Vancouver as well. So kind of been pushing us on Canada as a market, and is really asking why Tallbridge is not focusing on the Canadian market. And it's, you know, frankly, it is something we've discussed. You know, that said, you know, Tallbridge has been heads down focused on the US for the better part of 8 years, and
A lot of it, frankly, comes down to our comfort level, the relationships that we have. As I mentioned, the platform that we've developed through Tallbridge Real Estate drives a lot of organic off-market investment opportunities, which we feel is part of our competitive advantage. So it's not that we could not apply that to the Canadian market, but it's certainly a significant consideration. And frankly, it's a big market, and there is a lot of opportunity, and state by state things should change, and so it does present an opportunity for us to diversify. But Ray, happy to kind of tackle this with you, and we're staying opportunistic, so it's not a no, because we certainly have a lot of great relationships here locally and opportunities that come across our desk, but we're for the time being staying laser focused on the markets that we are comfortable with, familiar with. All right, I do have another question here, which is sort of a nice plug for Tallbridge. So it's, what are the ways in which I can work with Tallbridge? As I mentioned earlier, as an equity firm, we do syndicate for our projects. So if there's interest in learning more about some of our opportunities, learning more about our firm, would love the opportunity to sit down with you. Certainly over the coming months, you will continue to see communication come out from our firm with specific opportunities to invest. But I would always encourage anyone that's just keen on learning more to reach out. This is relationship-based business, in my opinion, and it takes time to develop trust. And it may not be a deal next month; it could be a deal 6 or 12 months from now. But it all starts with a conversation. So let's kind of start with that, and then we can talk specifics as we get into it. But lots of opportunities to get involved in our projects. And I will say the one other point is, in terms of participation, primarily focused on limited partner opportunities, but for certain groups there is a more strategic opportunity to get involved with some of our projects too. So happy to explore that. Perfect. All right. Well, we are coming up on 50 minutes, so I'm going to wrap things up. So again, just really wanted to thank everyone. Matt, thanks so much.
Thank you.
I learn a ton every time we have a chance to kind of really get into it. We do believe that the combination of all the market instability out there right now, macro pressures, some of which we've touched on, with this competing consumer pressure and demand, really does present an incredible opportunity over the next 12 to 24 months. But now more than ever, it's really important to be calculated, to stay patient. And the trend, is definitely in our favor in many ways. We just need to maintain mindfulness for the pitfalls, right? Sort of that slide, get back to the basics. Let's not lose sight of some of those key drivers. This is the time for everyone to be more particular around how they plan to invest, and we're certainly happy to kind of get into that with you and compare notes and see if there is a way that we can collaborate with you. As I mentioned, again, we are syndicating for our projects, so if you have any interest in getting involved, we're looking at opportunities right now, primarily focused in Texas and Georgia, as well as some opportunities in Colorado, where Matthew is based. So lots of great opportunities to get involved if you're interested in learning more. So again, thank you, Matt. Really appreciate everyone's time. I will circulate this recording, and look forward to bringing the group back together here hopefully soon to get into our next topic of conversation. So thanks, everyone. Have a great day.
Great. Thanks.
Thank you.